Good morning. Welcome to the Brew. Today, Thursday, July 11th, 2024. Today on the show, we are going to talk about option exchange pricing. So Mark has a lot of analysis on this today. And let's get right to it, actually. Here we come. Bam. What's up there, Mark? How are you? Welcome.
Lex, good morning. How are you?
Good. Do you notice that we are missing someone?
Yeah, Jason's off this week. It's going to be a quiet show today.
I didn't know he even took a vacation.
I'm surprised he's allowed to.
Yeah, that's weird, isn't it? Yeah, so we're going to talk about, well, you're going to talk about it. I'm going to ask questions because you know more about this than I do. We're going to talk about options exchange pricing, right? So on the liquidity side, where we used to live, every exchange has a little different mechanism to incentivize liquidity, right? And I hope we're gonna draw some distinctions between all that stuff and retail trading and talk a little bit about all this kind of thing, right?
So, yeah, absolutely. This is something that's near and dear to my heart. Spent a lot of time thinking about it as a liquidity provider and router of, lots of options contracts.
Yep.
But I think to cut to the chase, fees don't matter in the way that I think most buy side thinks they're going to. Right. It's not the fee that you pay. That's not what you should be worried about. They exist because that's what brings liquidity to the marketplace.
Right.
The other side of the trade is worried about that. They're concerned about which exchange it's going to go to, what maker fee or taker fee or breakup fee or PFOF or any of this soup of complexity. But really all that exists just so retail customers, buy side, have tighter, deeper, thicker markets, better liquidity.
Right. So how many exchanges are there, options exchanges are there today? Do we know? 16, 15, 17?
This is the trick question. Somewhere between 10 and 20.
So I go with 15 right in the middle, right? Safe. All right. So there's plenty of places. Retail folks typically don't get to direct their order flow, right? I mean, typically, some places they allow you to do that. Correct?
Yeah, they do. And I think there's very marginal benefit to that. I think the participants that are concerned with specific exchange routing are really playing some of those finely grained fee games. And those finely grained fee games bring better liquidity. They mean they'll pay $1.17 instead of $1.16. The fact that they do a certain percentage of volume means they get lower fees and will tighten spreads. But at the end of the day, if you're sending an order in as a retail customer, you should be concerned about, first of all, why you're trading that option, where it fits in your overall picture.
Right.
A little bit of price. Price obviously matters, the price you pay, but the penny isn't going to matter for most strategies that you're working on, right?
Well, it shouldn't, quite frankly. For a retail person, if you're playing the game for a penny, you're probably in the wrong business.
Totally agree. You sell that covered call at $1.45 or $1.46, no difference there. And that's the kind of, the granularity we're talking about at some of the most extreme prices. Taker fees on, the take exchanges might be $1.10 per contract.
Right.
So a penny, per trade price.
Okay. So explain for the folks what a taker fee, what does that mean? Because retail traders don't get that, right? They don't receive that benefit. That's for a dealer to get. Is that correct?
That's correct. And for most retail order flow, most buy side order flow is routed through these intermediaries that we've been talking about, the wholesalers, the dealers that are purchasing order flow and executing it. And they take all that job away from the end customer and the brokers also, because they're the experts in execution and they're the ones that are going to manage all of this, complexity to deliver ultimately a better price to the customer. And they're the ones moving all, do I send this to ARCA? Do I post this on BZX? Do I take from the Amex? Is this order going to collect PFOF? All those different kind of, decisions are all abstracted away. And, the retail player doesn't really need to think about that.
Right. So, in your estimation, every exchange has its own benefits for the dealer, and they're all slightly a little different, or are they all kind of in the more or less in the same ballpark, would you say?
Yeah, so sort of to your question before that I didn't totally answer about maker taker and whatnot, I'd say
Yeah.
there are two broad models for how to incentivize liquidity and charge for people to trade.
Okay.
You know, at the end of the day, you as a customer, you mostly want to get your trade off at your price and move on. Whether it's a spread, whether it's an overlay, whatever you're doing, you want liquidity. You want depth, and you want and depth in terms of size, and you want
Right.
tightness in terms of bid-ask spread, or effective bid-ask spread, wherever you get executed. Maker taker tries to set a fee schedule that will incentivize people providing tighter prices. That you get a benefit both in terms of the allocation model. Maker taker typically aligns with the price time allocation model, where you get a benefit for setting a better price.
Yep.
Meaning you're going to get executed first if you're the first one to set that price, but also you'll get paid to put that trade on. So if I provide liquidity, I might get paid 50 cents on ARCA, whereas if I take liquidity, I might pay $1.10 on ARCA to take liquidity.
Okay. All right. Got it.
The net going, of course, to the exchange for running the business of matching buyers and sellers.
Right. Right. Okay. Interesting. So when I get a retail trader ask me, how come we don't have direct market access? What's the snarky reply?
You don't need it.
Why?
Let someone else deal with that.
Yes.
There's no way that an individual routing has any edge over people that are routing, professionally across all those different exchanges. And I don't just say that because retail's dumb and whatnot, and the professionals are smarter or whatnot. Yeah. It's a function of volume, because so much of these, pricing edges come from executing the significant tiers of volume. So the retail trader actually gets the benefit of having someone else execute their order, because not only do they get price improvement, they get flagged as a customer and get to demonstrate to the world that they're non-toxic order flow, but they get to participate at the higher tiers of that, executing broker, who ultimately gets to trade that and provide them better edge. And, all of this really does flow through to the customer, and they don't have to do anything.
Yeah. They hit a button.
Bing.
Hit the send button. Yeah. I mean, listen, as you know, I interact with a lot of retail customers on a regular basis, and I don't get this question often about order flow and, can I direct it to a certain spot? The more pertinent question I get is, how are your fills? Right.
Yeah, and then fees come into that. Fees will definitely come into that, but they come in on the broker's side, right? The customer's getting a single price, and most of the time they're going to be executed in an auction or whatnot, and they'll just get the trade price, and the super fees is all managed on the back end. It's really about execution quality in terms of price delivered, not price fees paid.
Yeah, so there's no advantage for a retail person to say, I want to send it to SIBO versus.
I think you're more inclined to make mistakes.
Right.
Even as a professional trader that's thought a lot about this, I don't want that ability to be able to direct my order flow.
Yeah. Yeah. So I lost my train of thought there for a second because my dog was barking in the background. But what I was getting at is the more important question I get, which I think is interesting, and I'm not sure the answer, is how are your fills at Tradier versus Tasty, something like that. And I'm like, well, we probably use the same routes. I don't know the answer to that. They're the same, or they should be. And depending on a space and time, when you hit that send button, maybe Mr. Liquidity Provider's feeling better about that part of the send button than the one 6 seconds ago. I don't know. I mean, but they're going to the same place essentially, right? Or through the same routing mechanism.
And even if they're not going to the same routing mechanism, they're going to the same people. And even if they're not going to the same people are all watching the same places where those are traded.
Yeah.
And that's the beauty of the way customer order flow is executed in the options markets, is that it's highly competitive on an order by order basis. It's highly scrutinized and reviewed competitively on a monthly basis by these partnerships. And at a even longer duration, it's reviewed by the SEC and the regulators. So, kind of at every step of the process, there's a lot of mechanisms, including these fees, including the breakup rebates and auction incentive, all of those, those all go towards getting the customer the best execution possible.
Right. So the big answer is It doesn't matter. You hit the send button. It is so, first of all, it's so regulated. You're not getting a worse price, right? So if a market's 1 to 105, right? There's no way you're filling at 99. You're trying to pay for this. You're not going to pay 106. It can't happen, right? On a limit order, I should say. So that's not going to happen. Now, can you get price improvement? Well, guess what? Yes, you can. And all these clearing firm brokerages, they have execution quality reports that they get from every market maker. And if someone's a bad boy or bad girl on the market maker scale, what do? They get slapped on the hand. Say, hey, guess what? You got to improve yourself, or we're not sending order flow. You're going to be taken off of our wheel. Is that sort of the idea?
Yeah, that's absolutely true. And it's sort of a game where the bigger you are and the lower your fees, the better edge you can provide, or the more edge you can collect, which means better prices you can provide,
right,
in a competitive environment. So yeah, I think it's, you talk about like buying a stock fund or buying an ETF or a mutual fund, and they say fees, get your, SPY as low as possible, or your S&P 500, as low. SPY actually isn't great in terms of fees, but you should go to Vanguard or whatever. But like, that's what you should be concerned about when you buy a fund, an ETF or a mutual fund.
Right.
Don't even think about it with options trading. The fees are there, and they're for the professionals that are giving you better prices in the end.
Yeah,
don't worry about what you're paying to trade. That's not the most important part of an options trade.
And it's become, democratized more for all practical purposes. Retail trading, it is essentially free for a retail trader to trade now. Essentially, obviously, the Tradier side has special plans. Even 65 cents at some places. That's a slightly expensive, but we can provide that for virtually zero now because of this mechanism that's in place. And I always say to folks, you and I come from the same, past life, right? In the market making world. It was, it wasn't cheap to trade as a professional. We had low commissions, don't get me wrong, but there were other fees involved, exchange kind of stuff that was expensive. And once it became essentially free in the retail world, I was like, God, I don't know if I have as much edge as I think I do, especially since the whole dealer world went electronic and became an arms race, right? So now the big players with lots and lots of money can build a better mousetrap than the smaller guys. You and I can't go down to a floor and put on our badge and go compete with machines. It doesn't exist. My skill was being very fast physically, right? Great. Can't do that. Machines do it now. Doesn't exist. But retail people, guess what? I can trade on a screen. Now, I'm not buying bids and selling offers, but in my liquidity spots, doesn't matter. They're penny wide on Spider, right?
Well, that's the thing, is that like all these fees and all that competition and arms rates, it's just creating tighter spreads, deeper markets, better execution opportunities for customers.
Yeah, I agree. Yeah, we should take this up with Jason too. Maybe next time or next few times, is that, I think the trouble that a lot of retail folks have, right, is what is the edge proposition? Okay, now you've got a playing field that is truly in your favor as a retail person, right, from a cost perspective. But you need to have some sort of edge, and you're not gaining edge on a dealer. Okay, that is out of the question. So forget about it. They are there for a different reason for you. They provide your access point to make a trade, period. They have a different edge system. So, what I'd like to talk about, not today because we're going to run out of time, I'd like to talk about in a future show is, what is the retail trader's edge? What is it? If it's not buying business selling offers, what does it become, right?
I don't want to get up here and say, ignore fees, ignore the spread, but ignore fees and ignore the spread. Like your edge has to come from somewhere else.
That's right.
If you're on the buy side, that like, thinking about that, I mean, it's going back to the analogy of, the grocery store, that like, you're not worried how much they're buying the strawberries for. You're just happy that there's someone on the corner delivering fresh strawberries in a nice like quart container for you.
That's right. Yeah. You never complain to the grocery. I don't go to the manager of the grocery store and say, hey, can I get the strawberries for $3.79 instead of $3.99? If I need them, I buy them. They're $3.99. That's the market. Take it or leave it.
Right. Because you're making shortcake. Like,
That's
and
right.
if you're like, trading an option on a covered call, like that's a portfolio overlay. That's, maybe it's an opportunistic spread. Like no matter why you're trading, like maybe you think vol's mispriced, whatever your reason to trade, it should not be hampered, determined, based on spreads or the edge you're giving up or
Right.
the fee you're paying to put that trade on. Those are such infinitesimal percentages of what the overall objective should be when you're trading options.
Yeah. Okay. One last comment on something here. I just thought of something that we don't have to get too deep into it, but so if you're a market making firm, right? How do you choose? Are you making markets on all 16 exchanges? Again, it might be 15, it might be 17. So are you making markets on all those as a dealer, or are you just picking the ones that are advantageous to you to provide liquidity? What do you think the answer is nowadays?
I think that sort of comes down to like there's both a competitive question and there's a regulatory question.
Okay.
So to the extent that you're handling customer order flow or whatnot, like you kind of have to, there's not a written rule, but to demonstrate that you are providing a best execution experience, it probably behooves you to be a member at all the different venues. It also means that you're probably routing directly or connecting to them just from, a competitive standpoint, because, there might be, either it's cheaper to connect directly than route through like an intermediary broker,
Right.
or it just, it could be that there's opportunity there, right? And so I think the answer is probably, for the most part, because of those two factors, most of the big people are mostly everywhere.
Right. Right.
But their profile, varies significantly across all of those.
Right.
That's going to depend on the amount of volume that's at that exchange, their participant type at that exchange. So like if, for example, you're a specialist on an exchange or an LMM or a DPM or whatever they call them there, like those fees look significantly different than just a regular market maker. So that might mean you're putting more volume there because the ARCA market maker gets paid 50 cents on a rebate, whereas the LMM gets paid 50 cents, whereas the regular market maker only gets paid 30 cents.
Yeah.
So, that's a penny of stock movement on a 20 delta option. Like that's not insignificant, that 20 cents of difference there, right?
Sure.
So, there are a lot of those edge cases that I think are really interesting. And ultimately provide better execution, because that all, again, I'll say that all comes back to the customer. Like all those, the price improvements and competition and edging each other out, like that all delivers a better, a lower ask and a better bid and a higher bid.
Right. I love it. Okay. Very cool. All right, let's cut it there. If you have questions, throw them in there. Don't forget Mark, harvestedfinancial.com, right?
That's right.
And follow that blog. I love reading your blog, by the way. And plus the Dolly images are unbelievable.
I'm working on that one now. I'm surprised I'm talking about fees today.
Yep, there you go. Can't wait to see the image. The other thing, hub.tradier.com for more great content. By the way, we have a summit coming up. We're starting to make the plans for it now, so be aware of that. We'll have some information as we get nearer to that. It's probably going to be in the early fall is the next summit. So hub.tradier.com, harvestedfinancial.com, and check out Mark's blog. And we will see you next time on the Traders Workshop. What do you got to say about that besides
happy trading?
Happy trading. All right. Talk to you, Mark. Have a great week.
You too, Lex.
Thank you.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.